The financial reporting landscape across the university sector is under a microscope since Laurentian's filing for creditor protection in 2021. Today's update will provide you with a quick glimpse of the national and provincial funding regimes, an overview of McMaster's financial history and projection profiles, along with our risk management considerations. I'll also cover the Auditor General's recent reports on our sector and Laurentian. We will look at new sector financial sustainability monitoring proposals and the implications of each. And finally, we'll undertake a quick review of our sector's transparency requirements and how we grade. Federally, 4 main councils, including our foundation, provide $2.6 billion in taxpayer funding per year, where 99% goes to universities. These funding levels have been relatively flat 2006 to 2020. Recent increases are due to the New Frontiers research funding launched in 2018, followed quickly by COVID emergency aid funding and research. Provincially, funding allocation regimes are determined by each government-elect. Quebec and Saskatchewan use a mainly enrollment-weighted formula. British Columbia is funded by seats without a link to the types of seats, STEM or otherwise. Alberta and Ontario are shifting to performance funding, and other provinces are historically driven by adjustments made for new programs. Overall, what we can see is despite allocation approach, Ontario is by far the lowest funded province on a per student FTE basis. Finally, provinces control domestic tuition frameworks. They set limits or caps to annual tuition rate increases. This last chart shows you where Ontario sits with its overall average tuition level compared to others domestically. Noteworthy is that when you take the provincial funding and the tuition funding together by student FTE, Ontario fares lowest overall. As a consequence of controlled, limited, and low domestic funding per students, universities have focused on international student enrollment. This area of focus has provided the sector financial sustainability to address its annual expense inflation that is close to 70% fixed based on faculty and staff resource costs. With Ontario having the lowest domestic funding per student FTE, this province has made up that revenue gap with international enrollment growth and their tuition rate year-over-year inflation. Turning our attention to McMaster's financial sustainability, our historical enrollment growth is shown here, with projected growth lines showing what McMaster's enrollment might look like if growth remained on pace with the last 5 years. Shown here is the top green line, or if it slowed to 2/3 the past growth, shown here is the yellow middle line, and again, if we slowed our growth to 1/3 that of the last 5 years, shown as the bottom red line. Noteworthy is that the last 5 years of McMaster's growth, we were able to attract and secure greater and greater numbers of international enrollment, as shown in the next slide. This slide shows you McMaster's international participation shift from the 1980s of 2 to 4% to the early 2000s with 5 to 8%, and on to growth taking off in 2013-14 in parallel to Ontario grants and tuition increases deteriorating. Looking ahead at a low growth enrollment outlook due to more recent complications with international recruitment, we would expect our current 17.2% international participation to reach 23.6% by 2032 and 29.5% by 2042, noting that many of our Ontario peers are already at 25% international participation, with a high increasing reliance on Asia and India. Low growth enrollment means that revenue growth that we've enjoyed over the last 5 years will decline, and consolidated losses would occur if management mitigation planning didn't occur alongside. Management planning with enrollment planning occurs each year and is folded into the multi-year financial projections and a debt strategy report presented to the board after leadership consultation. A low growth environment potentially drives losses that can be mitigated in several ways. One of those ways is ensuring international tuition rates continue to inflate by at least 4.75% per year, even though historically we've been successful in raising those rates 6 to 8%. It also means that overall ancillary services would have to increase prices by approximately 2.75% per year, which might come more heavily from housing and food, and perhaps less so from parking, as an example. This also might mean an increased focus on alternative revenue generating activities that align with the university's strategy. As well, it might mean focusing more on expense containment, which has been higher over the last 5 years due to faculty hiring strategies and support to address the enrollment growth we've experienced, as well as ensuring expenses do not inflate by more than 4.25% despite future growth and market volatility-based inflation. Each option or alternative is something under debate and consideration by the provost and the other VPs as we set each year's budget outlook. On November 30th, the Auditor General of Ontario released its findings on the recent financial management audits of Algoma, Nipissing, Ontario Tech, and the University of Windsor. An audit initiated after the Laurentian insolvency filing in 2021, whereby a special report was released mid-November. The most recent findings provide 21 recommendations, such as all universities should have a debt management policy to manage, monitor, and limit external debt. All major capital projects should have a fulsome business case approved prior to project start that demonstrates the post-construction operating viability of the project. Board governance should include a skills matrix, a turnover plan, and adopt governance best practices, such as training orientations, fulsome transparent information about the university's strategy, financial resource allocations linked to the strategy within the budget, actual results and variance reporting. Universities should also address unprofitable academic offerings timely and make necessary adjustments. Findings also suggest the MCU needs to monitor taxpayer-funded universities and step in when they need help. The report also cites an increased reliance on international student enrollment for financial sustainability, which carries new risks, both geopolitical and visa access for entry risks. Included on the right margin are the highlights of the special report related to Laurentian, citing the Auditor General's conclusion on the insolvency. A similar citing of lack of major capital business case planning for post-construction operating feasibility exists, as well as lack of board awareness, information gaps between Senate and the board, and a lack of MCU oversight. Following the Laurentian insolvency in 2021, the Ontario CFOs worked with COU to propose a financial monitoring tool for MCU, one that was simple to administer, deployed an understanding of trends and smoothing, using a 3-year smoothing approach similar to that used within SMA metrics, and using 2 historical-looking metrics along with future-oriented credit ratings where available, all of which used to score and trend to action triggers. MCU recently shared its counter-proposal, focusing instead on 9 metrics without smoothing, which scores universities based on metric thresholds when determining action triggers. While McMaster fares well using MCU's proposal, it is concerning that it's based on 1-year results, which do not consider market volatility and potential action triggers that might be outside of the control of the university, such as investment income. Smoothing did help address this. MCU's confidential draft proposal scores 8 out of 9 metrics used to determine a color-coded action trigger, aligned with COU's proposal. However, unlike COU, MCU has not applied any concept of smoothing. Without smoothing, the results are subject to volatility related to factors sometimes outside the control of the university. The key difference between the simple COU smoothing model and MCU's multiple metrics on a single year model is under COU, only Laurentian requires a third-party advisor. And consistent with the Auditor General's conclusion, Algoma, Nipissing, Ontario Tech, and the University of Windsor do not. However, MCU's model, if not modified, will trigger third-party reviews across 10 of the 21 universities, which might be a good time for a reasonable CFO to consider a career change toward third-party advising. Under MCU's model, Even the University of Toronto will receive a warning letter, mainly due to its liquidity ratios. Whether the MCU proposal will form the future monitoring approach, right or wrong, if it is used as is, it will trigger change. Aligned with the Auditor General, MCU is looking to do more to review transparently the use of taxpayer funding and monitor financial health across the sector. Looking at sector transparency, COU's model suggests focus on 2 key ratios while tracking others for good monitoring, applying thresholds to signal actions, and ensuring universities post their financial metrics, explain financial information such as the full university budget, full annual financial report, and post credit reports where available. However, before the COU proposal, guidance already existed. In 2015, the broader public sector issued a documents directive, legislatively requiring universities to share publicly strategic plans, budgets demonstrating resource allocations supporting those strategic plans, inclusion of annual performance objectives and metrics, and reporting on those results, explaining objectives achieved or action plans were not achieved within the annual variance analysis. As an illustration, the 2015 Documents Directive maps nicely to the integrated reporting framework used by many organizations. Starting from the university strategic plan, a supporting budget with targets should be developed, followed by reporting on actual results and explaining variances and action plans for missed targets. So how are we doing as a sector relative to the Documents Directive? On the budget side, most universities do not provide a publicly available consolidated budget. One might ask if those boards see and understand the consolidated financial health of those universities. McMaster is reflected on the bottom of this list, and overall, only 5 of 21 universities provide full consolidated budgets. The Documents Directive requires budgets to be posted, but is silent on whether the budget can just be that of the operating fund versus all funds, operating, research, capital, trusts, etc. across the organization. As for the actual results, all universities post a set of annual financial statements, but only 6 provide financial health and performance metrics, and only 5 provide variance analysis. Again, McMaster is shown here on the bottom of the list. Here, McMaster shows that it doesn't report SMA metrics, but up until 2018, most of the universities, if not all, were reporting their SMA metrics. Metrics reporting is expected to pick up again next year when the SMA performance linkages to funding occur. In conclusion, Laurentian had financial health risks associated with major capital plans, transparency, board oversight, and compensation, among other things. But worst of all, MCU, responsible for use of public taxpayer funds, failed to see the issue coming, according to the Auditor General's report. As a consequence, a spotlight has been placed on financial health monitoring mechanisms, public reporting records, board knowledge and skills, and MCU monitoring tools. In conclusion, McMaster scores well on its public reporting record and financial health planning models, but further enhancements are likely as the sector shifts to further refined reporting.